Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, Aetherflux's $60 million plan to beam solar from space for the US military sparks a tech race and dual-use weapon concerns. We'll explore how this Pentagon-first strategy de-risks deep tech innovation and pits laser technology against China's microwave approach. Second, Palantir's 1,700% stock surge to a $432 billion valuation perplexes Wall Street, fueled by its controversial Team West AI strategy. We'll analyze why its unique AIP ontology is driving this rise and how it could affect competitive dynamics in enterprise AI. Third, Disney issues a cease and desist to Google-backed Character.AI, sparking a legal battle over copywriting an AI character's persona. In this episode, we'll break down this legal gambit and what it signals for the future of IP rights in generative AI. Fourth, Meta's new AI policy will use all user conversations for ad targeting across its platforms with no option to opt out. Today, we'll take a closer look at this aggressive strategy and its implications for user privacy and AI monetization. Fifth, a Trump-linked crypto firm plans to tokenize oil and gas as its USD, one stablecoin, explodes to a $2.7 billion market cap. This discussion will reveal how this project blurs private enterprise with national policy and what it means for international finance. The story begins with a decision that caught everyone by surprise. A startup is about to beam solar power from space down to Earth using lasers, and its first customer is the US Department of Defense. The company is Aetherflux, led by Robinhood co-founder Baiju Butt. It's backed by $60 million from investors like Bill Gates' Breakthrough Energy Ventures and Andreessen Horowitz, and it plans to launch its first satellite on a SpaceX rocket next year. The plan is a constellation of satellites, each transmitting power with infrared lasers. As CEO Baiju Butt described it, this allows them to distribute power generation across many satellites, and importantly, the receiving station on the ground can be made small. Aetherflux is betting on a distributed constellation of many smaller satellites instead of one massive single station. This choice is critical. A constellation is more resilient. If one satellite fails, the network can compensate, avoiding a single point of failure. It's also more scalable, letting them add new technology and capacity incrementally. This is a huge contrast to the monolithic approach we'll talk about later. However, if you zoom out, you'll see another layer of strategy at play. When you're talking about a private company operating a system that can beam high-energy lasers to precise ground locations, you have to ask about the security implications. This technology is what's known as dual use. It could absolutely be weaponized. The 1967 Outer Space Treaty, which is the foundation of space law, bans weapons of mass destruction in orbit, but it's completely silent on directed energy systems like this. This creates a massive regulatory grey area, a sort of Death Star dilemma that international law has not yet caught up with. The immediate goal is to solve a huge problem for the military, getting power to the battlefield without relying on vulnerable diesel generators that become enemy targets. But that's not the whole picture. An investor from Breakthrough Energy Ventures said the military is a difficult enough customer that if Aetherflux can serve them, it can scale the technology and drop the cost. This is a classic Pentagon-first playbook in the world of deep tech. It's how you de-risk incredibly ambitious projects. By securing a stable, demanding government customer like the Department of Defense, a startup gets critical funding and real-world validation. This is the same path used by companies like SpaceX and Palantir, who leverage government contracts to fund their research and prove their technology before expanding into the wider commercial market. It turns military needs into a launch pad for world-changing commercial tech. The real end game is to prove the system, then expand into the broader commercial market. This all begs the question, who else is in this race? Aetherflux isn't alone. Other companies like Virtus Solis and UK-based Space Solar are in the game. The situation presents a fascinating duality. We're seeing Aetherflux pursue lasers, while at the same time, China is taking a completely different path with microwaves. China has announced its own plan to build a massive 1 kilometer wide solar power station in space that will beam energy back using microwaves. Aetherflux's infrared lasers are very precise and allow for much smaller, more mobile receivers on the ground. The catch? Lasers can be blocked by clouds and bad weather. China's microwave approach, on the other hand, works in all weather conditions, day or night. The trade-off is that it requires a massive receiving station on the ground, potentially kilometers wide, raising huge questions about cost and land use. So the choice is between precision and reliability. The technology, once imagined by Isaac Asimov in the 1940s, is now a funded reality. While the company admits the tech is expensive now, the race is officially on. And when they say expensive, they aren't kidding. After all, the levelized cost of energy, that's the all-in cost to produce power for space-based solar, is currently estimated to be anywhere from 12 to 80 times higher than terrestrial solar panels. The biggest hurdle is launch cost. For this to even begin to be competitive, launch costs need to plummet from today's thousands of dollars per kilogram down to around $200 or $300 per kilogram. The challenge is no longer if it can be done, but who can make it cost competitive and win the global competition for limitless energy from the sky. Speaking of the Pentagon First playbook, another company that leveraged government contracts for its meteoric rise is now perplexing Wall Street. In 5 years, Palantir's stock has surged over 1,700%, rocketing its market cap to over $432 billion. To put that in perspective, when the data analytics firm listed in 2020, it was valued at just $16.5 billion. Now, it's one of the 20 most valuable US companies, soaring past tech giants like Cisco and IBM. This dizzying ascent has Wall Street completely perplexed. Palantir trades for 226 times its future earnings. That number dwarfs even Tesla. What's crucial here is the context. The average for the tech sector is a price to earnings ratio of about 23. Palantir's is over 240. The market isn't just valuing Palantir on its current profits, which are still relatively new. It's pricing in a future where Palantir achieves total market dominance, creating a technological moat so deep that no one else can compete. It's a massive bet on what's to come. The valuation has attracted major critics. Noted short seller Citron Research called the company detached from fundamentals and analysis, arguing its stock should be priced at less than a quarter of its current value. But Palantir's CEO, Alex Karp, doesn't shy away from a fight. His response to detractors, a direct quote, "Exit if they don't like the price." So what's fueling this meteoric rise? In 2023, Palantir launched its artificial intelligence platform, or AIP, designed to securely integrate AI for clients with sensitive data. The core innovation is something called an ontology. Think of it as a central brain that creates a perfect map of an entire organization's data, logic, and operations. This structure allows the AI to understand the real-world context of the business, which dramatically reduces the risk of AI hallucinations or making things up. It grounds the AI in reality, which is critical for high-stakes clients. The move was a game changer. The company's US commercial revenue jumped 93%, and it landed a software and data contract with the US Army worth up to $10 billion. And the interest in AIP is explosive. To give you an idea of the demand, Palantir ran nearly 850 demo pilots for its new AI platform in 2023 alone. That's a huge jump from just 92 the year before, showing just how fast businesses are trying to get on board. Karp, who famously moved the company from Silicon Valley to Denver while criticizing the tech sector's values, remains unapologetic about his firm's controversial government and military work. You know, the move to Denver wasn't just symbolic, it was a strategic play to break from Silicon Valley's groupthink. By creating a different culture outside the Bay Area, Palantir successfully attracts talent from defense and intelligence backgrounds, people who are mission-driven and might not fit in at a typical tech giant. This outsider status helps them win the very government contracts other tech companies often shun. This work includes a contract with US Immigration and Customs Enforcement, or ICE, to build a system that aggregates vast amounts of personal data to track and identify migrants, a use of AI that has drawn intense criticism over civil liberties and surveillance. He stands by his company's public support for Israel, and once asked, "Do you believe in the West? Do you believe the West has created a superior way of living?" That question isn't just philosophy, it's actually Palantir's core business strategy. The company is deliberately positioning itself as the default AI operating system for Team West. They are building a politically aligned tech bloc for the US and its allies, which is a stark contrast to the more neutral stance of other big tech firms. This has helped them win massive defense contracts, like a $480 million deal to build AI for battlefield intelligence under Project Maven. This all builds towards one of the boldest predictions on the market. On the day Palantir went public, Cart made a statement that now defines the company's entire story. We are going to be the most important software company in the world. While Palantir is building a technological fortress for the West, another giant is fighting to protect its own kingdom from the rise of AI. The Walt Disney Company just brought the hammer down on a major artificial intelligence startup. Disney fired off a cease and desist letter to Character.AI, warning the company to stop using its copyrighted characters without authorization. Character.AI allows users to create and interact with chatbots, some of which were inspired by existing characters that people love, according to the company itself. After getting caught, Character.AI didn't just back down. After removing the characters, a spokesperson for the startup immediately pivoted, saying, "We want to partner with the industry and right shoulders to empower them." Believe it or not, this partnership gambit is a core strategy for AI companies facing these legal challenges. They're trying to turn a legal liability into a business opportunity. The pitch is to offer IP holders like Disney the tools to create official, brand-safe AI personas, giving them total control while opening up new, officially sanctioned revenue streams. They are essentially turning a legal threat into a business pitch, offering IP owners the tools to create revenue-generating experiences on their platform. And make no mistake, this is a fight between titans. Character.AI is the same startup that Google inked a massive $2.7 billion licensing deal with back in 2024, and that Google connection is critical. Some industry analysts believe Google is using Character.AI as a kind of arm's length proxy. By investing billions in a separate, more agile startup, Google can explore legally and ethically contentious areas of generative AI, like creating chatbots of real or fictional people without directly risking its own massive brand. It's a way to innovate on the bleeding edge while maintaining a safe distance from the fallout. This conflict is just one battle in a much larger war. Disney is already entangled in a separate ongoing lawsuit against the AI image creator Midjourney, alleging improper use of characters from blockbuster franchises like Toy Story and The Avengers. This is where the situation takes a more complex turn. Suing an image generator like Midjourney is about protecting the visual likeness of a character, which is more straightforward under copyright law. But suing a chatbot company like Character.AI is about protecting the character's persona, their personality, their way of speaking, their very essence. The legal question becomes, can you copyright the soul of a character? Courts use what's called the sufficient delineation test, meaning a character has to have consistent, widely identifiable traits to be protected. It's a much murkier and more fascinating legal battle. The financial stakes in this new frontier are staggering. In a similar case, a federal judge just preliminarily approved a $1.5 billion settlement from the AI company Anthropic to a group of authors who claim their books were illegally used for AI training. The battle lines are officially drawn. Media empires are now mobilizing to protect their most valuable assets from the unstoppable advance of artificial intelligence, and the fight over who owns the future of content is just getting started. From legal battles over AI's creative reach to a direct move on our personal data, Meta just made a policy change that's impossible to ignore. Starting December 16th, every single thing you discuss with the Meta AI assistant across Facebook, Instagram, and Messenger will be used to target you with ads and content. And the company's been crystal clear about the rules. A Meta privacy manager went on the record stating, people will not be able to opt out of the upcoming recommendation engine change. This no opt-out approach is a huge departure from what we've seen from other tech giants. When we place Meta's policy alongside Apple's app tracking transparency, the contradiction becomes clear. Apple forced apps to ask for your permission times before times they could track you, an opt-in model that puts users in control. What Meta is doing is the complete opposite, assuming your consent by default and setting an aggressive new precedent. This isn't a small-scale test. We're talking about a feature that Mark Zuckerberg says has already reached over 1 billion monthly active users. The company gave a direct example. If you ask Meta AI for help planning a family vacation, your Facebook and Instagram feeds could immediately start showing you ads for hotels and reels of family-friendly travel destinations. And the rabbit hole goes deeper. This policy also applies to your voice interactions. If you're wearing the Ray-Ban Meta glasses and ask the AI a question out loud, that audio-based conversation will also be used as a signal to feed you ads. Now, Get this, using voice data from a wearable device is ethically and technically way more complicated than just typing a search query. The system is designed to activate when it hears a wake word, like, hey, Meta. But research shows these devices can have what are called false wakes, where they accidentally start recording private moments. Even more, the inconspicuous nature of these glasses means you could be recording bystanders without their knowledge or consent, which opens up a whole new can of worms for public trust. So, what's the real endgame here? This move reveals Meta's entire strategy for making money from AI. While rivals like OpenAI use a subscription model and Google integrates AI into its enterprise products, Meta is doubling down on what it knows best. Its massive advertising empire. They're betting that by feeding your AI chats directly into the ad engine, they can create hyper-personalized ads that no one else can match, and that's how they plan to recoup their billion-dollar investment. In a media briefing, a company manager acknowledged that users probably already assumed this was happening, but now it's official policy. But that statement itself is a fascinating strategy. When a company says you probably already assumed this, it's a tactic some experts call normalization. The goal is to make a significant privacy shift feel inevitable and already accepted, which can lead to something called privacy fatigue, where we all just get tired of fighting for our data and become resigned to losing it. It's a way of managing public expectations to reduce backlash. The only way to avoid this new level of ad targeting is to not use Meta's AI features at all. The company has drawn a clear line. If you engage with its AI, your conversations are now officially part of the ad targeting engine. It's important to note this isn't a done deal everywhere. In Europe, for example, regulators are pushing back hard, questioning if this policy even complies with their strict GDPR privacy laws. That battle has actually forced Meta to delay the rollout there, showing that this new approach is far from settled globally. While Meta draws a hard line on using your data, another politically charged venture is blurring the lines between private business and national strategy, a crypto firm linked directly to US. President Donald Trump is making a massive new play, announcing plans to tokenize real-world commodities like oil, gas, and cotton, putting them directly on the blockchain. Now, this sounds futuristic, but tokenizing physical assets, what we call real-world assets or RWAs, is a monumental task. It's not just a tech problem, it's a legal one. You have to create a secure, verifiable digital token that represents a real physical barrel of oil or bale of cotton. The legal framework for this is still being built, and a key question is whether these tokens are treated as securities, which would bring a mountain of regulations. This isn't just a simple plan, it's an incredibly ambitious and complex goal. The company is World Liberty Financial, co-founded by Donald Trump Jr. Its CEO, Zach Witkoff, just announced a new debit card designed to bridge crypto assets with everyday spending, set to roll out as early as the end of this year. But the bigger bombshell is the move into physical assets. Witkoff stated that commodities like oil, gas, and timber, frankly, should be traded on-chain. And this isn't a startup with a dream. World Liberty Financial's stablecoin, USD1, has already exploded to become the 5th largest in the world, with a market capitalization of around $2.7 billion. This rapid growth comes as one tech firm, Out5 Sigma, is set to buy $750 million worth of the company's digital token. The reason this growth is so shocking is that it signals a major shift in the stablecoin wars. Unlike competitors who focus on compliance or tech, USD1's go-to-market strategy appears to lean heavily on its powerful political brand. Interestingly enough, despite using terms like on-chain, which suggests decentralization, on-chain analysis shows that the project is, in reality, highly centralized. For example, research indicates that the liquidity for the USD1 stablecoin comes from just 3 wallets, and the Trump family maintains significant control over the token supply. This is a classic case of what some critics call decentralization theater, but the real story isn't just the money, it's the mission. Despite facing accusations of conflicts of interest from opposition lawmakers, the company claims its goal is to benefit America's national interest and maintain dollar hegemony. So the thing is, these accusations are popping up because existing ethics laws, like the Emoluments Clause, which prevents officials from receiving foreign gifts, were written for a world of real estate and cash, not global pseudonymous digital tokens. How do you track who is buying these tokens and for what purpose? This has led to new legislative proposals like the Digital Asset Market Clarity Act, which would require a president's family to place digital assets in a blind trust to avoid these very conflicts. The firm's CEO put it bluntly, stating that their global push for the USD1 stablecoin is designed to convince people to buy US treasuries. In his own words, it's great for the US dollar. This transforms a crypto company into a declared instrument of national economic strategy. What we're seeing here is a fundamental blurring of lines. This private, politically connected project is being pitched as a tool for US foreign policy, specifically to reinforce the dollar's dominance. This is a completely different approach from state-led projects like China's digital yuan, which is a central bank digital currency, or CBDC, controlled directly by the government. Here, we have a private company acting with explicit geopolitical goals, raising profound questions about systemic risk and the future of international finance when private power and public policy become this intertwined.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.